All right, Chart. Well, since we got you on here and we're already talking about crude oil, you've got a nice trade in the money in crude oil. So I got a 15-minute crude oil chart. Is that an appropriate time frame to look at so we can walk through this trade?
Yeah, that's fine.
Okay.
Okay, so I mean, this is a falsifiable trade with a good ratio based on my base case assumptions about the mode of behavior price will be in right now. We had a lateral consolidation followed by a decisive breakout a couple days ago. I believe that this should be a very directional trending move up to a test of 60 out of that breakout. And for it to be that mode of behavior, you're not going to see significant lower lows in the pattern. So in that futures, if you have futures up, right?
Correct.
Okay, so you'll see the pre-market low around 58.
Yep.
And we pulled back in the context of that. It should form a higher low. So basically you have something that's kind of the character of an ascending triangle right now that's just come into play as we've moved back up to those highs.
Yep.
You want that ascending series of lows anytime there's a shakeout, because that's, if you've got a very directional trending move, you're not going to see that significant break below that previous low on something that really is, I think, just a shakeout after a period of a couple hours of just congestion around those highs. You get momentum money coming in, it bangs against somebody who's sitting on the offer, eventually it rolls over just enough, people become a little over levered on small time frame trades, and they just get shaken out, and it cascades down. You should see rising point of strong-handed demand coming up. That's what's fueling the move. So we should see that be a higher low. So the setup's falsifiable because if it breaks significantly under 58, it's really not that same mode of behavior. So I shouldn't see that. And, with an outside target of probably above 60, I've got a great ratio to that risk. So it formed a good setup, and it's in line in the direction of my bias in that market right now.
All right. Next inside target might be?
I want to see how it behaves. I haven't picked it out. I'm
Okay.
not looking at the level there. I know the level that I'm looking at is 60. So if it is really grinding and consistent, I might just let it keep going because it's showing me that kind of process that I want to see. I think there's still skepticism in here. And that's one of the things that I like about this market, one of the reasons why I'm interested in this trade. I think that there is a healthy amount of skepticism about crude oil prices because of what we see in global growth data and in the dollar. And what we can see right now in CFTC data, there's just not a lot of large speculator interest. So as it starts to creep higher, I think you've got a lot of non-believers to convert, along the way. People who would need to be positioned in crude oil, even commercial hedgers, they fall asleep too. You got people like working for airlines. They need to hedge against higher crude oil prices. If it starts to trend, they don't have enough hedges in. Those guys got to get in there and start buying. And again, if you've got non-believers and you see directional trending move following a breakout, the price action alone can be the best advertisement for the market. And it can convert people who are sitting there saying, oh, this breakout's not going to last, and then it just continues, and it trends, and it forces people to come in. So if I see that kind of grinding, steady move out of this pattern above the earlier highs today, then I think that we're going to start to make it an easier path to 60. So I may just let it keep going without taking that intermediate cut. And that may allow me to ride a final piece on maybe a trend exhaustion or breakout exhaustion move above 60, maybe above 60.50, maybe even testing 61. We do have a 200-day moving average on the continuous contract at 62. You and I talked a couple weeks ago about the possibility of it moving to touch the underlying, the underside of the very long-term trend line, which would actually be closer to 63.
Mm-hmm.
So there's a lot of stuff up there that it could probe, and if it starts to get a little parabolic because we've got low amount of large speculator interest. We have people who've maybe fallen asleep in terms of commercial hedges. That's possible. I mean, that's a long ways away from where we are right now, but I think I kind of try to envision different scenarios so that when I see something, I'm not caught off guard. If I see it start to act that way, then I would let it run further. So I haven't really picked a target. Now, if it just spikes really hard on a headline, I'll probably take something even at 59. So we'll see.
I'll tell you what, looking at a daily chart here, I could make a case this could potentially make a run at 65.
Yeah, well, and that would be an upside flush through the underside of that trend line.
Exactly.
And then you've got the kind of the low of the range that we had before the breakdown from
Exactly. Yep,
early
yep.
mid next year.
I could definitely see 65, 66 area as a potential target on the upside of, if you're
Yeah.
willing to wait that long. I don't think it'll happen in a day. You'd need something really fundamental to some
Yeah.
type of fundamental headline going on that
Well,
would really shake things out. Go ahead.
yeah, well, let me just kind of contextualize this even more. Regardless of what happens with this particular trade, I think the situation for crude oil right now, again, you've got a lot of skepticism in there, particularly when you look at global growth. There's a lot of easy reasons to doubt the move, or you look at the move in the dollar and what's possibly ahead for the euro. But I think that that's not really, at the end of the day, what drives crude oil in a lot of cases. There's a lot of plumbing that goes on that's really important to appreciate. And I think one of the big narratives that we have started to develop on further and further actually goes back to August of 2017 when we had Hurricane Harvey hit the Texas coast. Do you remember that process, all those refineries getting shut down and flooded?
Mm-hmm.
Yeah, and we had an enormous spike in the crack spread as we had, a stoppage of refining operations. So we had a huge glut in oil and a huge paucity in gasoline and refined products. And I think that was a traumatizing experience for those guys. And I think that the response was, and this is one of the things that we talked about back then, one of the reasons to be bullish on crude oil at that point was that they would need to respond by starting to stockpile gasoline. And it's the same thing that I grew up in Florida, and we have a lot of hurricanes in Florida, and it's the same thing that you see. It's a strange process, but it's the same thing that you see from small towns where there's a bad hurricane that hits and people suddenly are faced with the specter of the plumbing gets shut down in a lot of cases, and they don't have water. And so people, when they think a hurricane is going to hit, they usually go to the store and buy lots of bottled water. But occasionally you get an unprepared situation, and what happens is after the hurricane is gone, after the plumbing's back on, the grocery stores start to sell out of water because people have been traumatized by that process, and they start to stockpile because they don't want to go through it again.
Mm-hmm.
Anytime another storm hits, it just people end up filling their third bedroom with bottled water just because they've gone through that before. And I think we saw kind of the same thing from gasoline refineries following Hurricane Harvey. They just simply shifted to a different level of standard stockpiles built up of gasoline in case something were to happen to refinery operations. And we went through that process for a while, and I think that one of the reasons why we saw the big collapse in oil late last year, if you look at the timing of it, and you look at the crack spread, and I posted this chart back then, it's one of the reasons why I was bearish on oil at 68, because we had the crack spread already diving. And one of the reasons why I think that happened is because we just gotten out of hurricane season for 2018. So the next year, when hurricane season ended, there's not really a risk suddenly of hurricanes when you get to October. And I think what we started to see then is that they built up a lot of gasoline to protect against the same thing happening that following year. And then we had a glut of gasoline. And the glut caused a contraction in the crack spread. And so we've been working through that for the last several months. And we've worked through it so well that I think we've gotten to the opposite end of the spectrum. And that's what was signaled in February when we saw the crack spread take back off to the upside. I think that we overshot working off that hurricane prep, trauma-based, PTSD kind of trauma-based hurricane prep stockpile of gasoline. We overshot working it off. I think these guys are now really sitting at a relatively thin level, and I think that that's why we're seeing this jump in the price of gasoline versus crude oil, which is really what it's about, and that just makes suddenly they're sitting there without as much refined product, and the profitability of any next marginal active refining is much greater than it was a month and a half ago. And I don't see how that doesn't drive the price of crude oil up. So I think that that's the more important dynamic that's sitting there. Whatever global growth is going to do, long-term demand issues are important, but I think that they're just sitting there in a situation where they're going to start to be more aggressive in refining operations, and that just means you should see data just like we saw yesterday, draws across the board and bigger than expected. And I think that that's what the market is going to be preparing for here, is a series of data points like that. So that's why we would see this breakout. That's why we would see maybe a directional extension up to 60 and above.
All right. Have you noticed a pattern? I talked about it a little bit yesterday. I don't know if you heard, but lately it's been a pattern that I've seen where whatever the EIA data is going to be, like a big miss, big beat, whatever, the market's moving in that direction ahead of time before before the number comes out, as if somebody has that number and the market's reacting to it, and then it comes out, and a lot of times we'll see, like yesterday, we saw a continuation through that level. But have you noticed that too?
Yeah, all I can say is there's two explanations for that. And one is obviously that somebody has found a way to hack into something, and that there's a network of people who are sharing that information, and money has gotten behind the project. I
Clarence
think that that's
speaks.
less. I think that yeah, that's a fantastic reference. Trading places for anybody who doesn't get it. Yeah, the orange juice futures. Oh my gosh. So the other explanation I think is more likely is that it's probably a small sample of observations on your part and my part. I've seen the same thing, but small sample could be explained by randomness, or it could be that there is a kind of sense among larger players, and particularly commercial players, of exactly the dynamic that I just described, and that as we get closer to that data point coming out, instincts or whatever take hold, and people reduce risk on betting against that dynamic playing through in the data. So, but again, you said it happens in both directions, and I'm not sure how to explain that, and I would just kind of lean toward the idea that, most likely it's some degree of market discounting by smart people being scared of being badly wrong, and some degree of randomness.
Yeah, I was just curious if maybe you've noticed that it has been a trend recently, and it'll be when we all start noticing that it'll be the exact opposite to not do it anymore. So,
Yeah,
you,
exactly.
you only got a couple more, if any, so just take that as you will. There is a quick question here. I know you've answered this one before, but one of the listeners wants to know if you have a rule of thumb whether to take or not to take a trade based on how far a the listener asked about a stock, but in this case it's a future, where the price has moved from the time that somebody can physically get their entry into a trade versus where you post it. Like in this case, there was slight slippage between. I think you got in at 58.24. I saw that you could have gotten it very close to that level, but there has been times in which there's this element of slippage. And do you have a rule of thumb that you would advise somebody to take or not to take a trade?
I do not have a rule of thumb. I think it's got to be case by case and depending on extent, and it really just has to be does it make any sense in the ratio? Now, in this case, I guess you could say I said we've got a target at 60. Um, you could take it if you got in at 58.30, 6 ticks worse. You could take it with 46 ticks of risk. You have your stop in the same place, and you've still got a great ratio on the trade. So I guess that's part of it. That's part of the consideration. If I'm barely getting 2.5 to 1 on a scalp trade, and it moves further than that, just after I post and before you can execute the trade, then suddenly you're looking at, a 1.5 to 1 ratio if you use the same stop as me, but a worse entry. In other words, a wider risk level.
Hmm.
So it hurts on both sides. It's further toward the target, and it's a larger risk level, so the multiple just shrinks dramatically. If you're suddenly looking at something that doesn't make sense as a setup in terms of the risk you'd have to take, then the next question, and I realize this is tough to do in real time very quickly, but the next question to ask yourself is, if I use the same total level of risk, is the setup no longer falsifiable in terms of where the stop is? And that's a very nuanced judgment. And I think that, maybe if you, after a while of taking my calls, you develop kind of a sixth sense of how to go through that choice architecture in a really efficient way. But I would say the most important thing to consider is if initially when I put the trade on, I usually kind of give some sense of what I'm targeting, or perhaps I have, in a previous talking, and I think that I've kind of outlined this 60 level a little bit. You can see that that's, over 4 to 1 on that risk right now. That gives you a little more leeway to just chase it.
Right. I know I've kind of developed that in my own way just by watching your trades and where you look to take some profits, take some stuff off the table. And if anyone's interested, I could provide what I've seen that seems to work, and where you might want to back off taking a trade from where the entry might be. And I've also seen plenty of times where uh, it would move, and then it'll come back and come right back to your level, or right around that level,
Yeah.
retest it. And I would say that happens
I think that happened
more
this
than
time
50,
too. I mean,
yeah, well, more than
came
50.
back down to 58.25, I think, maybe 2 minutes later.
Right, so I think it happens more than 50% of the time, of the times that I'm actually watching these particular trades. And I can't speak for what happens in the afternoon because I'm not here and I'm not as staring at the screen as much, but it happens frequently enough to where if you have a little bit
Yeah.
of slippage, like in this case, if it was, say, 10 ticks and you're a multi-lot trader, you might go in with one and say, okay, well, I know chart trader tends to look at he'll take some off the table when it gets to that 1.5 ratio. So if you're willing to stay on board for that next one, well, then even if you got a one lot on, you're still going to make some decent profit, and then you can make some money from there. But put on the one, and then work the extra that you want to at the entry price that you actually got in, and
That's a
scale
good way to think about it.
and scale back in, and then you basically are able to take advantage of it on both ends. You just
Yeah.
have to realize that, okay, I only have this one unit on, so I'm probably either gonna make the decision whatever his maximum is, I'm on board with it, or I'm gonna go for that mid-level profit taking, which tends to work out more times than not from what I've seen.
Yeah, I mean, you're diversifying your cost basis. And I
Yes.
think that that's a good strategy.
So, if anybody cares to know my opinion on what you could do during that time, feel free to ask and I'll help you out. So, therefore, let's move on to the equity markets. You've been very quiet lately. Does that have anything to do with Brexit, or is it just a function of one of the variables that just hasn't lined up for you yet?
Well, I mean, it's a function of the same process we've been talking about, the conundrum of seeing sentiment data and positioning data, and I'm waiting for the Bank of America Merrill Lynch Fund Manager Survey to come out, because I think that's going to be the next final input in just reaffirming that yeah, we still have this situation that I've termed overbought and underowned as this sort of conundrum for somebody who trades with my strategy in equities, when you have technicals that are stretched, but there is such a sense of people having been pessimistic, money being on the sidelines, that it's very difficult to try to fade that. And then you really just need, clean headline-driven setups. We need headline-driven shakeouts, and we have not seen headline-driven shakeouts. That's the go-to setup in a situation where you have too much money on the sidelines and you have a market that's a bit stretched out to the upside. You just need that headline to come in, shake things out. You know you're going to get that support because that money is sitting there as a buffer. But we really haven't gotten any of those sorts of setups. And now we have a VIX that really is just a stone's throw from having a 12 handle. And that's going to be the lowest handle we've seen since before any of the corrective action that we saw late last year. So the VIX has really kind of dwindled down. So I'm not as motivated to be aggressive in equities until or unless we see that kind of juicy headline-driven shakeout.
All right. So I've been pretty surprised by how resilient the FTSE has been over the course of the last couple of weeks. And I know a lot of things have been telegraphed and whatnot, but even some of the bad news seems to still be a buy. It just keeps grinding higher, the FTSE.
Yeah, it's a strange situation.
Mm-hmm.
I think that the pound is kind of reflecting the same sort of mentality. So yeah, I mean, I'm not sure that I fully understand it, but I assume that the market's doing its job. It's not completely out to lunch, and I think that the biggest issue probably for both of those scenarios, what's buffering that, is that you do get a sense that the game theory's lined up around the avoiding the no-deal exit, and no matter what finer details are, to some extent, that's going to happen, and there's a lot of pessimism that's been built into the equation in the first place, and there's a lot of people coming up with, probably something that will end up being something that's a little bit smarter than we think that they're capable of doing, which is usually what I find happens in these situations. Sometimes When you go through a process like this, it seems like everybody's just making the situation worse over and over. But underneath the surface, there are good ideas coming from smart people that are percolating up through, and it ends up being a little bit better than you give it credit for, the whole process. And if that rule of thumb kind of continues to play itself out, then we're probably going to end up with people figuring out a way to muddle through this in a way that's not devastating to the UK. And I think the market's probably reflecting that.
Yeah, for those looking at the Trader Audio visual, well, this is a bad one. Let me see. All right, so I do have a British pound chart, a British pound futures chart, and you can see we've looking like we're trying to put in a little bit of a bottom here, forming base around this 130. 130's been that key level. If I recall, when the Brexit was first announced a couple of years ago, 130 was that key trigger point where it just got slammed, and here we are, 130 being a key inflection point, putting in this bottom here.
Yeah, you're exactly right. That is exactly the process, and we found our way. We really are kind of at the midpoint of the whole crazy move. It was kind of like, it was one of those elections where the polls show something and then the polls get upset by the opposite result.
Right.
So you saw the pound rip higher on the night of the Brexit vote and then just get slaughtered as we started to see the math adding up through the process that it wasn't going to work out. And, then we paused, went sideways, and then we spiked down again. And if you look at that whole range of movement around the month or two following that decision, we're pretty much in the middle of it right now. So I think you can kind of think of it like, it's almost like a biotech approaching an FDA PDUFA date, as far as binary outcome. But I think that resilience that you see is the idea that we're probably going to get something that's not that bad in the end. And I suppose there is a little bit of a chance, like you've kind of noted, that maybe the only way that this ends up resolving itself is with somehow some kind of second referendum that overturns the whole process.
Yeah, and I do have a monthly chart up. I presume, was Brexit June of 2016? That ring a bell?
Yeah, absolutely.
All right, yep, and there's that big down move. So there, you can see that on the Trader Audio chart, that's where it is, and you can see where, right where the range is, and smack dab right here in the middle is where we are. So key inflection point right around here, 133 now we'll call it. So 130 to 133 is a big zone for the pound if those keeping score at home. Brett, got to ask you about a little bit of a divergence that I saw last night in the yen and the Nikkei. Did you pay attention to that?
I did not. So, I've noticed that the yen is, in its aspect of signaling when we've got risk-off sentiment starting to move through everything, it has not been reflecting that even when we seem to get news that shows up in the treasury market that way. So that's the main dynamic I've been focused on, but I haven't really been watching the Nikkei actually at all lately.
Yeah, so it's been somewhat choppy, but last night was the first time that I've seen where it, for lack of a better term, decoupled from the normal trade
Inverse,
that you see. Yeah, the inverse relationship where the yen goes down and the Nikkei goes up. Last night, the Nikkei was down with the yen down. The yen right now, I'm looking at the yen futures down 0.7%. Look, not a big deal in the context, in the grand scheme of things. However, when you see that, my red flag goes off, and the little bells in my head go off and say, I got to start paying attention to this, and then I got to ask Brett about it.
Yeah, I see the dynamic you're talking about, and I don't have an explanation for it. If we start to see it more consistently, I would start to think more about it. One day, who knows, maybe there is some headline-related narrative I'm not aware of that could somehow account for that in some logical way. But if it happens over the course of 2 weeks consistently, then I would start to say, hey, there's something really strange going on here. But I don't have an answer for it now.
Yeah, and that's okay. If you did, there's no downside to asking if you might have saw something that I didn't see. Part of my job is to point out some of these discrepancies that can help people make money, and you hadn't been paying attention to it, so had I not said it, you can't say 2 weeks from now, oh, Jim, 2 weeks ago you didn't tell me about this. So that's part of.
I've got one theory. Here's my theory.
Okay.
We're seeing a greater diversification in terms of the source of carry trade positioning, and that would be the euro becoming a more important source of that, which would mean that, and I don't know if this necessarily accounts for the Nikkei's behavior, but it may account for a lack of a yen rally in situations where we're seeing something like the China data we got last night, and apparent breakdown in talks between China and the U.S., which you think would generally spark some closing of carry trade exposure, and it doesn't seem to have shown up. Now that actually doesn't really explain the lack of the Nikkei reacting to a downside yen. But I mean, what we're talking about right here is something that should have been a bullish catalyst for the Nikkei, and the Nikkei wasn't able to rally on it.
And still
Right?
hasn't. The Nikkei futures haven't rallied, and
Right.
that's what really caught my attention. Not so much that the cash index itself didn't respond. The next thing I do once I see that it didn't respond is look at the futures and where they're actually at, and they continue to trade lower, and they're actually outpacing the U.S. to the downside. And that is just one of those things that, because I've
Right.
traded overnights for so long, I gotta at least mark this down, pay attention to it, and see if this becomes any type of trend going forward. And if it doesn't, I just wasted a little ink, you know?
Right. Now,
So,
one final way to analyze the situation would be to look at the idea that the Nikkei is in a bear market. If that's the case, then one would see a lack of upside reaction on yen down days and a more exaggerated downside reaction on yen up days.
yeah, and that's a good point too. That Nikkei, it can really move. I remember when you were trading that
Mm.
when uh, the earthquake. Remember the earthquake?
Yes.
Yeah, you
That
were
was
all over that.
amazing.
Yeah.
That
So
was, yeah, that
it,
was an amazing trade.
the
10% in a couple days.
Yeah, and the only thing I will warn is that Nikkei futures is a big tick size, so
Yes.
yeah, have a big account ready for if you are going to dabble in the Nikkei futures. So, all right, let's see, where else should we go? I got to talk about the gold. We've had a nice little pullback today.
Yeah, right. And, I would like to see a shakeout back down to the level we saw. And again, just like we talked about last time, I would love to see 1275-ish, 1270, even 1265, and just get long and hold it. I mean, I want to see that kind of shakeout setup. I don't want to need to chase it back above 1300, but I may feel like I have to, and that just puts me in a position I don't like to be in. But I would love for it to cooperate here. I would love for the euro to break down further. I would love for the dollar to spike. I would love to translate that into a little bit of a further shakeout in gold, especially. I suppose the Fed could help me out here. If we get a little bit less dovish rhetoric than we're expecting at next week's meeting, that would kind of possibly get me that move. If we see a little bit, everybody's expecting such a dovish kind of mentality from the Fed. If they surprise away from that just a little bit, it might help that shakeout. It might help the dollar extend. Might help gold pull back. And I would like to see that tag of that January low level and maybe just a flush underneath it. And then I think that you've got an extremely bullish picture when you look at the scrunch up weekly or the monthly chart.
Yeah, and I was going to ask you what that level was because we previewed this last week, I think it was last week, about a potential opportunity, and because we had this pullback today about 1% or so, I couldn't remember exactly where that level, that shakeout level was, but that makes sense. Well, no, let me see. So this is a March low, and this is January low. They're almost the same, right?
Yeah, are you looking at the continuous contract?
I am looking, let me see. So this is April active. Um, so okay, yeah, there is a little bit discrepancy. So are you talking about
Your first low is at a different contract, yeah.
yeah, so 1275 would
Yeah,
be
I mean, you want that January low is right around 1275, yeah.
okay, yeah, okay.
And the low we just got on the continuous is right around 1281, and so we'd want to see a shakeout. I'd like to see a shakeout that breaks the stops at 1275.
Okay.
And that's the buy.
Okay, got it. I am putting a line there right now, and I'm going to keep it there. What color you want to make it? Blue? What's your favorite
Blue's
color,
good.
Chart? Because you're a Florida Gator
Green
fan.
green is my favorite color. I've
Well,
decided that one.
yeah, mine too, but you're a Florida Gator fan, so I'll use that Florida blue.
Blue.
Yeah, there you go. All right, so the next one I'll put, for your cell, I'll put the orange one for you, just for you.
All right.
All right, so we got a a prep here on this gold. We'll be looking for a breakdown potentially through the 1275 area, and then do you look for an overshoot, or do you look for the comeback? In the comeback by meaning where it makes the tail and then it shows some momentum back to the upside. Do you look for that, or do you put your
You
level
mean when
where
I
your level?
actually when I
Yeah.
actually enter?
Yes.
Yeah, I'd like to see some kind of resilience show up in the tape. I want to know, the way I think about it is the overshoot is the process of de-risking, because the people who were vulnerable to selling their fingers around the sell button, but you don't know where they are or who they are, they're the people that hurt you when you're in the market, right? They're the people that make it tough for you to hold your stops. They make it tough for you to have conviction in a trade. When you bust through a level and you get that flush, you get that higher volume, after that subsides and we start to see things still out, quiet out, and then maybe start to poke back to the upside, you've already shaken those people out. They are now off the bus. And I like to get on the bus after they've gotten off. And yeah, I want to know that the process of them getting off the bus has ended. So I want to see the tape quiet back down after the flush, and then just start to show me something that feels a little constructive. It doesn't have to come all the way back. I just need to get a sense that the character and the tone of the tape on smaller time frame charts has shifted in terms of its mode of behavior, and I'm starting to see things that make me feel like the order flow is constructive again after we've had that more emotionally intense follow-through when we've hit and broken through an important level.
All right, so gold is down today about 15 bucks, so that puts us only about $20 away from that 1275 area. So get ready. At least throw gold on your radar as a potential setup, put it on your watch list or whatever it is that you do, because Chart Trader could be pulling the trigger on this momentarily. And as you guys know out there, I like to get as much information, prep information as we can to get something on the radar so that you guys are prepared, not scrambling around when he actually does pull the trigger on it. So any other markets that you want to focus on today, Brett?
No, I mean, I guess, we have that continued kind of strange situation in terms of how treasuries are behaving relative to equities and commodities in general. And I think the inflation data just kind of bears that out, and I think that there is this kind of conundrum that people are facing because we are seeing unquestionable evidence of a broad global slowdown in economic activity that suggests that the treasuries market is reacting rationally. And when you look at what commodities and equities are doing, there's this discrepancy, and I don't think we've seen it work itself out in any way that's truly satisfying. But there is a possibility. I wrote this a couple days ago that we're sitting in a situation where we've seen essentially what amounts to I wouldn't call it a mid-cycle slowdown, maybe a late-cycle slowdown, but there are blips like that where you see the initial scouts of the bear army shoot across the battlefield, but the army's not there yet, and we need to go through another process where we start to pick things back up again, and that money off the sidelines comes roaring back in, and eventually the Fed needs to start tightening again, and maybe then we roll over, and then we get a more serious version of a cyclical downside of the mountain. Or, we may be there, and it just may be a slow developing process right now. I don't think you can know, and I don't think that it's deterministic. I'm not a fatalist. I think that the outcome is not to be known right now, and we're kind of going through the process of figuring it out. We reached some pretty powerful levels of vulnerability early last year, and I've talked about this a few times. In terms of the sentiment data that we saw at the late January, early February highs of 2018 are the types of data points that you see characteristic of the end of the primary thrust to the upside of the bull market. Which would mean that we're in some form of topping process now that would be tough because of how extreme and extraordinary those readings were. It would be tough to see a serious new leg develop out of this that has, real staying power for any serious length of time. And we did follow that up by augmenting the economic data with fiscal stimulus, which is going to be very difficult to have a repeat act. The impact of that fiscal stimulus is gradually dwindling at this point, and we just do not have the functionality in Washington, D.C. to get everybody on board with a plan to produce any more fiscal stimulus. Not that I think that would be a good thing in the long run. I don't think you want to do that at the top of a cycle, but if you're looking for where to be bearish on the cycle, one of the things you'd have to watch out for is a level of political coordination in Washington, D.C. that could help extend the cycle with some new great big infrastructure bill or something like that. And it looks like that's probably impossible at this point. So we're strictly down to monetary tools, and we've already got the Fed on pause. And I think that you would need to see some signs of contracting economy and a much greater downside in the equities market before you saw actual and important levels of easing from the Fed and new accommodation, something like new QE. I know that they've talked about it a little bit, but I think that's more about preparing the landscape for how to behave when and if we face that kind of challenge. So I think that it's tough to get that new serious extension, but you may suck in some of this money off the sidelines, and we may get a retest, or we may exceed the highs that we put in late last year. And if you look at past tops, there is often that kind of sawtooth pattern where you get a few sharp pullbacks and highs that are not necessarily breakout highs, but they make just a bit of a higher high, and then you start to pull back again. And that's where the concept of something along the lines of a Head and Shoulders comes into play when you play this out over the course of a year or two of that kind of process. And certain sectors, leadership sectors, start to gradually fail to confirm those new highs, and you get that process, and that process usually is not a quick one. It takes a long time to form a major top, and it takes a lot of steps. So you don't want to at any one moment say, you're putting everything in on the bear side because you're positive it's happening. It's impossible to keep conviction in that pattern. You really need to get to the point where we've seen more confirmation, and then you can get really aggressive on the short side, and bear markets can be tremendously profitable with that attitude, but you don't want to jump the gun. You don't want to be early on that kind of strategy.
Yeah, for sure, indeed. I'm looking at this SPY weekly chart, so you can look at any S&P equivalent chart. I could see a head and shoulders pattern kind of maybe forming. It's very, very early stages of the right shoulder. But do you ever do anything like that? Do you ever maybe look at a potential I don't know what you call it, a textbook type setup, and kind of theorize around it?
Absolutely. Well, I mean, one of the main things I do is I say, this is what other people are seeing,
Mm-hmm.
and it gives me a sense of why people may be behaving the way they are.
Okay.
But if this was the outside and finalizing shoulder of a Head and Shoulders pattern, to be reliable to me, I think that you would need to see a lot more excitement right now in the market, and a lot of people overcommitted on the long side, particularly retail, particularly smaller accounts. That's the type of thing that builds the vulnerability that allows you to easily start to roll that over. And I don't see that at all. There's just so much skepticism, and the market is more resilient than it should be in the face of the level of difficult news that we have and difficult risks out there, and all of that adds up to something that's really tough to bet against at this point for me, even though I don't love it. I don't love the context, and I've got a lot of long-term ideas that make it difficult for me to see a really positive path in the back half of this year and in next year for the market. So it's just a very analytically difficult situation, but I would like to see maybe this move in lateral consolidation, and then maybe poke up and actually retest that high or break through that prior high and see another kind of strong sense of a sentiment blow off, and then start to see that deteriorating action on the heels of that, and then it starts to look a little bit more reasonable to me. But I definitely do think in terms of traditional pattern analysis, particularly when trying to understand what I think that other people are seeing and what may be kind of trickling down through broad market collective psychology.
All right. This is the last one for me. One of the listeners highlighted when we were talking about the Nikkei, sounds like you were on the other side of the Nick Leeson trade. Man, I'm not that old, man. Are you familiar with Nick Leeson?
God, that name rings a bell, but I can't remember what.
Yeah, he took down the Barings Bank. He was loaded up on Nikkei futures and options. They made a movie about him, Rogue Trader. Have you ever seen that one?
I have seen it, yes.
Yeah. Terrible movie, really. But
I kind of liked it.
well, I mean,
It was a bad movie. It was a bad movie. I don't know. I just like movies that focus on that kind of thing. I guess that's more, there's so few that focus on the drama of markets.
Well, what's his name? The actor, Liam Neeson. Liam Neeson. That's right, right?
Was it? Was it Liam Neeson?
Liam Neeson played, let's see. Yeah, no, not Liam Neeson. I'm thinking of the other guy. But
Are
anyway,
you thinking of Liam Neeson just because if you change the N and the L, it would
you know,
pretty much
that's
be-
what's confusing me. But no, the guy.
Ewan McGregor.
Ewan McGregor, right? So,
Yeah.
Ewan McGregor went on to play Obi-Wan Kenobi.
the other Jedi. Jedi.
Yeah, the other one.
Yeah,
That's
right.
why I got him confused. But yeah, he went on to bigger and better things. He became Obi-Wan Kenobi in the prequels. But it was a terrible movie. But I don't. If you have a spare hour and a half, it's not bad. It's a good trading lesson not to hide your losses.
Yeah, right.
So, all right. Anyway, Brett, as always, keep us posted on your next move in this crude oil future, and jump on if you have any updates or if you're seeing anything. When do you expect Chart Book to be out?
Well, I've got most of it written, and I really just need the fund manager survey, which is usually out mid-month, and sometimes it was out on the 12th last month. And that's really kind of the final data point for me to put together what I believe is the most important section of any chart book, which is the initial equities market analysis contrasted with the sentiment data backdrop. And that's become a more important input for me.
Just curious. Think you might ever be able to get your buddy at Sentiment Trader on? Are you that tight
I
with
can
him?
ask him.
Yeah.
We've had a few different phone conversations, and I think that would see it maybe as an opportunity to expand his own brand, so I can definitely hook it out to him.
Yeah, I think it might be beneficial because I'm sure that you've asked him some really good questions that some of the listeners might actually like to know and expose his business, because I know you follow it quite a bit.
Yeah.
So, all right, well, maybe we'll throw that on the agenda. So, as always, Brett, thank you so much for joining us today. Let's see, let's look at your crude oil position. Looking good so far, and we'll be rooting for that to keep moving higher. Thanks a lot, Brett.
You got it. Thanks, Jim.
All right.